Hi, and thank you for joining us for Moss Adams's webinar titled Weathering COVID-19 Market Volatility. Uh, Obviously, right now is trying times. A lot of things are brand new in the social and business world, and we thank you for taking time out of your busy schedules to be with us, with you. A lot of hot button issues that we want to tackle from a market and tax perspective today. But before we begin, I just want to add in a little disclosure that the material appearing in this presentation is for information purposes only and should not be construed as advice of any kind, including without limitation, legal, accounting, or investment advice.
My name is Scott Peterson. I'm a senior manager in our private client practice. I work with executives and business owners doing comprehensive tax planning.
And my name is Rich Friedland. I am a senior financial advisor in our wealth management private client practice. I work with high net worth individuals, business owners, and executives.
These are obviously some uneasy times, and the market has been very volatile. So we thought it would be helpful if we shared some common questions that we've been receiving from our clients and some hot topics. So that's the 3 or 4 main pieces that we'll cover on this slide deck. So the first question to Rich: how should I be structuring or restructuring my investment portfolio in times of volatility?
That is a very common question we've been receiving lately, especially with what's going on in the environment. We've been receiving this question from a positive and negative perspective, all of which are covered in an interesting manner. To answer this question simply, rather than to be what's called reactionary, taking action in response to something, I think sound advice is to always start with a plan. Regardless of what you're doing, have a plan. Because if you have a plan going into something, whether it's a coronavirus or financial crisis of some other sort, you'll have the mentality to be ready for it, at least more so than if you don't. And when I say plan, we're speaking mainly from a financial perspective, so a financial plan. A financial plan is one in which you determine your goals, your needs, and eventually your appetite for risk. And why that's important is because when you have a sound plan that's set in place and you're revisiting, whether quarterly, yearly, etc., you'll know that you've already taken into account times of fear, which we're in now, so that you won't have to make quick judgments and quick decisions based on, as an example, which way the market's moving. That's number one. The other point to stress is that you want to have structure rather than a restructure. Structure is always more important than restructuring. And this comes from proper planning. If you're planning appropriately, you're building downside risk. And that's something we're experiencing right now. If you're, as an example, fully invested in a portfolio, whether it be in bonds, stocks, or a mix, you are experiencing some form of downside risk. And knowing what your structure should be is more important than trying to find immediate value for a quick buck, so to speak. We do believe that there is opportunity for certain types of investors, specifically those that are holding cash. Many investors keep a buffer of cash for several reasons. When I say buffer of cash, I'm specifically speaking to those investors who have cash ready to invest and not operating cash, because you don't want to put that kind of money at additional risk. I think the most important theme here is to stick to a target. And right now, a lot of investors are out of target. And when I say target, as an example, if you've gone through a financial plan and you've determined that you are a 50-50 balanced investor, as an example, that would mean that you're in 50% fixed income or bonds and 50% in cash, 50% in equities. Right now, you're probably over allocated to fixed income and underallocated to equities. So right now is a good time to get to target. As long as you can do so tax efficiently, then maybe selling some of your bonds to bring yourself back into target, or putting some of that cash that's been sitting on the sidelines to work is a good opportunity to restructure your portfolio currently. I think buying on the down is always warranted and desired. There is a stroke of luck that needs to be taken into account here, but when you can buy in on the down, that's a perfect time to restructure.
So, Rich, I got a question and surrounding real estate. So let's say we have a client that is looking at buying investment real estate or rental real estate. A, do you think it makes sense to enter the real estate market now? And B, where would I pull from my portfolio to fund any cash outlay?
Yeah, real estate has always been a hot button issue for many clients, especially those on the coasts. Well, I think the very first question you want to answer to yourself is, am I willing to leave my house to go see a piece of real estate right now? And if the answer is yes, and you've got your N95 mask at the ready, then the next question you want to answer is, does this fit into my plan? Because when you look at it from high level, although the markets, and I'm specifically referring to the stock and bond markets right now, although they've taken a hit, that doesn't mean that real estate has. And in fact, real estate has not taken that much of a downside hit in this current environment. There is potentially less demand right now simply because a lot of investors don't want to leave their house. But that's a certain segment of the economy. Supply is still out there. Folks are still listing their homes, listing their properties. Private equity is still looking for some type of value in the marketplace, and there has been a slow up in that arena a bit, especially on the residential side. So really what you would want to ask yourself is, does this property or this investment fit into my financial plan? Do I have the cash available for it? Have I been planning for it? Or am I, as I said earlier, reacting? Because, just to repeat, real estate is still expensive, and you need to be sure that you can monetize it appropriately in this environment. So you as an investor need to be prepared if, let's say, you get into a property and you're doing so for investment purposes. Are you going to be able to find a renter in this environment? A lot of folks aren't leaving their house, and there's a reason for it. So you might be sitting on a mortgage for quite a while. And if your portfolio is down, or you run a business and your inflow is down, are you going to be able to maintain those payments? In short, there's always room for real estate in a portfolio if it suits you as an investor, or if it suits your personality to be a landlord. The question is, do I do so now? And I don't think that you want to relate that or make that response or that answer in relation to the fact that the stock market has gone down right now.
No, I mean, I think that makes sense. I mean, my only comment on that when I receive questions from clients, and even my own personal opinion, is let's see how the shakedown goes with the economy. Because you hear some things of people being furloughed and there's layoffs, so there could be even more supply in the market than there is now in the next 2 months, 3 months, 4 months. So it's almost like a wait and see approach for real estate, in my opinion. But is that something you agree with?
I do agree with that statement. I have always agreed with that statement, wait and see, because at the end of the day, it boils down to, can I afford it? And is this valuable to me at the price it's at? As long as you find value in that real estate, regardless of its pricing, I think if you are in love with this house and you set your threshold at X as the max you'd pay, and if it falls within that threshold, great. And if you have the ability to pay for that house in the worst environment, great. Then maybe that's an investment for you. And I do think that a wait and see approach, especially 3 to 4 months from now, is not a bad idea, because I don't think the supply will go away. and demand is already at a high. So I don't think we're going to see too much movement there.
Okay. So the second question that we've been getting a fair amount of is, so with everything being said, so far, what should I be investing in?
Well, okay, that's a great question, and one that's very pointed and that we receive all the time. I think I'll answer this question in two parts. First, I want to relate it back to real estate, and then we'll talk about the market as it sits right now. When it comes to real estate, let's say the answer to should I purchase a property is yes. Now the question becomes, how do I do it? How do I fund this investment? And our opinion is in the following order. The first and probably best way to do so right now is through the concept of margin. And with Fed funds at an all-time low right now, margin loans are, for certain types of investors, very appropriate and very useful. They're close to zero, and for those investors who, as an example, are heavy in bond holdings, they can margin up to, depending on the type of bond, a max of 70 to 75% of their portfolio. So essentially, you're not liquidating any of your positions. You now have this credit line available to you at a very low cost, and you're able to get that property. Actually, before I keep going, Scott, maybe you can mention anything about, from a tax perspective, using margin.
Yeah, definitely. So when you have a margin loan on something, it's either investment interest or it's personal interest. So if you take out a margin loan and you buy a boat and, a plane and all those things, that's personal interest. So you wouldn't have a deduction there or a tax benefit. But if you're buying an investment property, that would be investment interest, which you'd be able to write off on Schedule A. Or if it's a rental property, you would source that to the rental and offset any rental income against the interest that you're paying on that margin.
Yeah, and to give a real-world example, just imagine you have a $10 million bond portfolio. Let's assume for a moment these are very safe AA, AAA California municipal bonds, as an example. You can margin a portfolio like this up to 75%. With Fed funds being close to zero, you might be paying a couple of percentage points max, depending on the negotiated rate with your bank, and you won't have to sell any of this portfolio to buy the property. So now, effectively, you can essentially pull out a loan at 1 to 2%. I'm using this as an example only, and you can draw on this without having to liquidate any of your bonds, still collect the interest, and now you can have about a $7.5 million cash draw available to you. So margin is the first concept that we like. After that, bank loans, obviously, they're going to come with a slightly higher interest rate, but still, rates are very low right now. And for those investors who don't want to give up cash, this is definitely a way to go that we would recommend. And finally, it would just, if the loan process is not for you, or if you don't qualify for whatever reason, then if you're going to sell from your portfolio in order to come up with the funds to pay for a property, just do so tax efficiently. So if that means looking at gains and losses and trying to negate those capital gains as much as possible, and if you have those capital gains right now, good for you, but do so in such a way that you're not going to have a heavy tax burden at the end of the year. Getting into the stock market, what should we be investing in? That's the question we get a lot. And obviously, can't give specific advice, but what we like are the concept of blue chip sectors that have value. And when I say blue chip, I don't mean blue chip stock. I mean high-end, high-grade, asset-allocated sector investments. So think passive index funds invested in large sectors like the U.S. economy, international Western developed Europe, strong emerging markets, infrastructure, and even global real estate. A lot of these index funds are solid regardless of the fact that they've gone down in value. Right now, effectively, almost everything in the market has gone down in value. And a lot of good quality positions, namely index funds, in my opinion, have gone down along with the rest of the market. And those can be purchased with extreme value right now. Most investors who are holding such positions or have been thinking about holding them as of 2 months ago, if you think about it from a business psychology standpoint, if you purchased it 2 months ago or for the last several years, you paid a certain price. Let's assume that price is 100. Now, effectively, the price for a lot of these funds is down to 70. So realistically, you're getting a position in something that you already found value in at 100, now at a 30% discount. That's the same concept as we were talking about it with real estate. If you find value in this real estate, regardless of the fact that it might be $200,000, $300,000 more expensive today versus tomorrow, you find value. And that's, as long as it's driven from a financial plan, this shouldn't throw you off mentally. You should still have peace of mind that you're getting into something valuable. Otherwise, there's just a lot of risk involved.
Okay, so another question that comes to mind is, it's a very volatile market right now. I mean, do we see any areas, or any sectors that look like in the near term will be very volatile?
Well, I think it goes without saying that we're already seeing a lot of volatility in very specific sectors like industrials and transportation, commodities, and even riskier corporate bonds. So a lot of people are asking, should I be getting into the airlines? Should I be buying oil? Should I be buying this, that, and the other? There's a lot of volatility there right now. There's a lot of risk. There's even a lot of volatility and risk within the tech sector. 1 minute we're seeing technology stocks super high because people assume they're going to be staying in their homes and using only tech. The next day we hear about a virus or potential virus and it shoots down 20%. So there's a lot of immediate volatility in very specific sectors right now. This is why I'm truly a fan of indexed investing, where you're getting into a broad range of asset classes, not something specific, and you're buying those at a value. I think that is really from a long-term perspective position. That's where you're going to find tremendous value moving forward. Okay, so we'll switch things up a bit. And Scott, I'm going to ask you a question. In this environment right now, what are the opportunities that you are seeing for mitigating tax under our current market environment?
Yeah, definitely. So I'll briefly touch on the CARE Act. The Moss Adams team has an entire area dedicated just for the CARE Act and has presentations on that. But there are three things that really caught my eye when I was reading through it from an individual standpoint and also a business owner standpoint. The first has to do with the RMDs, your required minimum distributions. So those are not required in 2020 for certain retirement accounts. There's stipulations and everything. You can really get into the weeds, but essentially most qualified retirement plans, you no longer have to make that 2020 required minimum distribution. The other one is, which I think is really powerful, and we'll touch on this in a little bit, comes around the NOLs. So within the Act, they made the carryback rules much more favorable for business owners. Now you're allowed to carry back, losses that are incurred between 2018 through 2020 to the preceding 5 tax years. So that's a situation. If I was a business owner, I would definitely be evaluating the options to potentially carry anything back to get more cash into the company or into the owner's hands. And then the other thing, it might not seem like a big deal for everyone, but people who are very philanthropically inclined, there was a change to the AGI limitations for if an individual were to give a cash contribution to a qualified organization. So now that AGI limitation is 100%. Previously it was 60%, meaning if your adjusted gross income was $100 before the act, you could only give $60 before you get limited on your current year deduction. That's the 60% AGI rule. Now that's been lifted to 100%. So for those who are philanthropically inclined, that's something definitely to have in the decision tree. And then to, really get down to three things, one is gift taxes, one is NOLs, and then one is option exercising. So the first thing that I'll cover, it might not be, breaking news to everyone, but from a gift tax strategy, it's much better to gift when values are low because that uses up less of your lifetime exemption amount. So something that used to be worth $1 million is now worth $700,000. It might make sense to look at potentially gifting lower valued assets, which will reduce your lifetime exemption amount, but by less than it would have earlier in Q1. For NOLs, so this is what I was talking about in the CARE Act, but these rules are very favorable now for business owners, and there's an opportunity for business owners to claim these NOLs and carry them back to preceding tax years and get cash back into their pockets personally or back into the business. So, I got a question for you, Rich. What would, business owners do with the additional funds, or what should they do with the additional funds from a personal financial standpoint or otherwise?
Yeah, another good question. And I do get this question from business owners who are more risk prone, so to speak, and looking at the market as an opportunity. Because we come from a more conservative standpoint, we would never recommend that a business owner put any operating cash at risk. We do like the concept of having an operating account and generating some safe yield on cash that might not be utilized on a day-to-day. I like the concept of buying high yield cash funds. You want to be careful specifically to which cash funds you purchase, of course. Some are taxable, some are tax-free, some are tied to corporate paper versus municipal paper or short-term treasuries. But I do believe that getting into some kind of high yield, government-backed, short-term cash fund is not a bad idea right now, especially for corporate cash account of this sort. You're generating some yield without taking on very, very, very little risk, and you're earning tremendously more than you would in the banks.
Got it. Yeah, and the last piece that I wanted to cover was option exercising strategy. So this is more for the executives, those who are working with companies that offer stock options. You may be a founder, or you may be, an executive at one of these companies. So the concept of when you exercise a stock option, what you end up looking at from an ordinary income standpoint, because I'll cover non-qualified stock options in this scenario. If anyone has questions, I can talk to them about incentive stock options as well. My information is on the last slide. But from a non-qualified stock option standpoint, what ends up happening is you look at your strike price, which is essentially your cost to exercise, and the fair market value at the time the stock is trading, if it's a publicly traded stock. If it's a private company, then you would look at the 409A valuation. But what happens is, in times with market volatility, it might be a situation where, the price of the stock is declined by 20 or 30%. So what that does is that shrinks that spread between that exercise cost and the fair market value when you exercise. And by shrinking that spread, you pick up less ordinary income, in an environment like this. So, it's just something to think through and talk to, your financial advisors about and your tax planners about any exercising strategies for non-qualified stock options. So I think that's all I had, at least for this presentation. Rich, was there anything else you thought you wanted to chime in on, or?
Just that whatever decision you make from a tax perspective, an investment perspective at this time, make sure you're doing it with a plan. Make sure you're going in with a calm, cool head, because that's usually when you make the best decisions. So if you have any questions, feel free to reach out to either one of us. We're happy to walk you through it and help you give some planning.